Hi, morning. Let's start. And I'm quite excited about this session today. And uh, what I'm going to do today is I'm going to talk a little bit about how our house view is for 2024. I've got friends from Wellington today. I've got friends, Jeremy, who's here in Singapore, Dan, who we worked to launch this fund almost 9 years ago in US, and it's really relatively late at night. But I want to get in quite into detail and give more time to Jeremy and Dan. But let me just summarize a couple of things. Firstly, I think for those of you who read our outlook for 2024, ultimately we believe that the hard part is over. Ultimately, global expansion is going to continue, but there is a situation that it is going to be for higher, a little bit more higher for longer. That means you've got to get your money to work. You've got to find opportunities out there. We think there are opportunities in both fixed income, there are opportunities in equities, but there is a slight tilt towards equities itself. Now, we've got a really interesting strategy here today, and that's called the Durable Equities Fund. And it's something that we worked together with Wellington almost 9 years ago. And it's really about the journey and the experience of the product that's relatively different. I was just searching a little bit. When we launched this product, and then we had the opportunity to bring Dan around the region and talk a little bit about this. And I look back at that time, and it's not dissimilar to the situations now. Maybe the players have changed a little bit, but in 2014 when we launched 2015 when we launched this fund, it was on the back of a relatively large crisis. And for those of you who remember, that was the PIGS, Portugal, Ireland, Italy, Greece, and Spain. People were worried about credit. People were worried about growth. In fact, actually, in 2014, that was the year that the invasion of Russia and Ukraine actually happened. And today, 10 years down the road, we are in a situation that's relatively similar. Now, the premise of the fund was relatively simple. Look for interesting names, names that people don't really look at, do the deep research, and actually deliver long-term returns. And I think if you look back, our annualized return is about 7%. Constantly, if you look at the 1 year, 3 year, 5 years, our returns are around the 7 to 8% mark. And that makes it a relatively interesting product for you, for your clients, for your portfolio. And I think today, more than anything else, I think we want to share a little bit more about this. How is it positioned? How is it going to be aligned going forward? And we've got Dan who will talk about it a little bit later. But before that, I'm going to pass it on to my friend Jeremy. Jeremy is going to talk to you a little bit about what he sees in the market, what the opportunities are there, what are the risks, and then he will pass it on to Dan, and we'll talk a little bit more about the Durable Equities Fund. So I really hope you enjoy the session. It's something that we've been looking forward to. Jeremy, on to you.
Fantastic, and thank you for that warm introduction, Shankar, and thank you for everyone taking time out of your busy schedules to listen to how we see the world, but also why we think durable enterprises is such a compelling strategy to think about in the current climate. And so, with that, the first point I would just want to touch on is how do we see the world today, and what is the economic backdrop look like before I hand over to Dan. And so, we have a proprietary index at Wellington called the Global Cycle Index. In the late half of 22 and into 23, it was our view that the global cycle would inflect and expand, and we saw that play out. Now, as we look over the course of 2024, our macro research is really giving us the view that we should continue to see, a level of economic growth, and also a level of disinflation. However, at a slower pace that we saw in 2023, and there will be some volatility along the way. Now, it's our view that our research is telling us that by the end of the year we should have an inflation rate closer to 2.5%, and that coupled with positive economic growth is a reasonable setup for owning risk assets. So similar to Shankar and the views from UOB. Now, I think it's important to appreciate, though, that the path of the global economy still has a very wide range of outcomes. And so, whilst the market is significantly focused on, this optimistic outcome of a soft landing, we should be conscious of a wider range of outcomes. The second point I think it's worth sharing is, with the current backdrop, how do we think about investing capital, and are we in somewhat of a different regime that we haven't seen over the last few decades? And I think the answer is yes. I think over the coming decade, we're in a period that's going to be characterized by higher and more variable inflation, higher interest rates, and fluctuating economic growth. And so, as a result, how investors generated returns in equities, potentially over the last few decades, may be very different in the next few decades. And this is really one of the key reasons why we believe durable enterprises is an extremely compelling strategy to think about in the current climate. So whether or not we see stronger economic growth or a more challenging environment, what's extremely appealing about this strategy is that we own a set of companies that are less reliant on that backdrop, that are able to perform well because of idiosyncratic risk in the underlying businesses. So we're not reliant on generative AI continuing to see this exponential growth and investor enthusiasm or a cyclical upswing. This is a portfolio that can take advantage of dispersion across industries, across geographies, and really ultimately our goal is to identify companies off the beaten path that are very resilient, very stable, that have excellent management teams and can grow because of idiosyncratic drivers. So with that, I'm going to hand over to Dan to really go through his PMP. Dan is the architect behind this strategy. He's the portfolio manager. He has been a long-standing partner of Wellington, and he designed this strategy, as Shankar alluded to, over a decade ago. And the intent when he designed the strategy was aiming to achieve compelling returns with less risk than the market. So with that, I'll say thank you very much for joining us this evening, Dan. I'll hand the floor over to you. And would you like me to start on slide 9?
That's great. Thanks, Jeremy. Thanks, Shankar, and thanks everyone for joining. Actually, Jeremy, if you can just go back, we can just leave it on the philosophy page or the objective page. That's good. Sorry. So thanks everyone for joining. And as Shankar said, I remember vividly in 2014, I think, and then again in 2016, spending time with you and your colleagues in Malaysia and Singapore and Thailand, and great trips. And it's really been my pleasure and privilege to work on behalf of UOB and its clients for 9 years now. It's been a terrific relationship, and I'm very grateful. As they alluded to, I started this strategy. I've been at Wellington for almost 19 years now, and I started this strategy in 2012 with one simple goal, which was to make 10% annualized returns for our clients with less risk than the market. I chose 10% very specifically for 3 reasons. One, it was a level of return that I felt was achievable in the marketplace and in the kinds of companies that I feel competent to invest in. Second, it was a level of return. It is a level of return that I'm comfortable making with my own money, and all of my money is in these strategies. And then third, it was a level of return that I thought could outperform the broad markets over the long term, not every year, but over the long term, and particularly so with less risk, and that proposition might have some appeal to clients. So that's the goal. Very simple: 10% annualized returns with less risk than the market. And we try to accomplish that goal by investing in companies that share 3 common characteristics. The first is that they are resilient businesses, and we define resilience by if we can imagine cash flows. The cash flows, if we can imagine the cash flows of the company declining by more than 15% in virtually any scenario, then the company's not a candidate for our portfolio. Importantly, that tends to eliminate certain areas of the market from our investment universe, namely commodity companies, and companies with high degrees of economic sensitivity. Historically, it has also led us away from very fast-growing companies with high returns. Our starting place in investing is that high growth and high returns tends to attract competition, which ultimately erodes resilience and stability. And so we have generally not invested in fast-growing technology companies, and that obviously has implications for our relative return profile in certain market environments, and particularly this one. So that's the first criteria, resilience. The second criteria is the management teams that we invest our clients' capital in need to be exceptional, really in two areas. The first is that they need to be great at execution. And to us, execution means turning 2 or 3 or 4% revenue growth into at least as much, at least that level of profit growth, 2 or 3 or 4%, and hopefully more. The companies that we tend to invest in on behalf of clients don't have organic revenue growth rates at the 10% level, oftentimes more in that 3 or 4 or 5%. And so one important way to translate that revenue growth into our return, our 10% return objectives is through excellent execution. The second way to translate moderate organic revenue growth into our 10% return objective is to be excellent at capital allocation. So we focus very specifically on how companies spend the cash that the businesses generate. Some of the companies in the portfolio pay dividends. Some of the companies in the portfolio repurchase stock. Some of the companies in the portfolio buy other companies. And ideally, many of the companies in the portfolio do a mix of all of those different activities, just depending on what the highest and best return use for their cash is in any given year. Oftentimes, we invest in companies where the management teams are significant owners and in some cases founders of the businesses. We tend to like this owner-operator mentality because we think it leads to the best long-term outcomes for shareholders. Just to say, so those are the first two criteria, resilience and good management teams. I would just say, I think it's important to say that those are not particularly controversial criteria. If you met 10 investors, I don't think you would find anybody who would say we were looking for unstable businesses with bad management teams. So inherently, I don't see anything terribly interesting about prioritizing resilience and good management. Where our strategy gets interesting, I think, is the third criteria, which is price. Jeremy can tell you I'm a very cheap person, both in my professional life, in the stocks that we own on behalf of clients, but also in my personal life. If my wife and kids were here, they would tell you the same thing. And so the way this strategy gets interesting is we look for businesses that share those first two criteria, resilience and a good management team, but also this third criteria, which is they trade at quite moderate valuations. And the free cash flow yield of the portfolio today is a little bit less than 8%. It's about 7.8%. And all that means to me is that if the businesses can't grow at all and the management teams can't find anywhere to reinvest the cash that the businesses are generating, and they give our clients back the cash flow from the company each year, that we can make 8%, 7.8, 7.9% annualized returns. It's not all the way to our 10% goal, but it's a significant portion of it. And so really, the way that we're able to find companies that have these two universally desirable characteristics, stability and good management, at this moderate valuation is by looking in areas of the market that Shankar alluded to that are a little off the beaten path. We tend to own a lot of small and mid-cap companies. We tend to own companies in sectors that don't have a reputation or an experience of being stable, such as financials or industrials. We sometimes own companies in countries that are temporarily out of favor, like France or Italy. And oftentimes we own businesses with financial characteristics that disqualify them from traditional high-quality approaches. So many of the companies that we invest in tend to have moderate rather than really high returns on invested capital. Some of the companies that we invest in don't pay any dividends at all. And some of the companies that we invest in use moderate financial leverage to enhance shareholder returns. And so for one or more of those reasons, either because it's a off the beaten path company, or they have a certain financial characteristic that makes it unappealing to quality-oriented investors, these companies tend to slip through the cracks. They don't grow fast enough for growth investors. They're cheap relative to their stable attributes, but they're not cheap enough for deep value investors. And they tend not to meet the high bar or the high criteria for quality investors. And if we're doing our job right, that's a great thing. We like to say that the stocks that we own on behalf of clients live in investment purgatory. And to us, that means we get to combine two attributes that tend not to live together in the market. Stability on the one hand, which provides a platform for long-term compounding and downside protection, and value on the other hand, which provides another source of downside protection, as well as higher long-term expected returns. So that's how we try to accomplish the 10% return goals. Jeremy, if you go to slide 9, please. We think it's important because the portfolio is roughly 35 stocks from around the world. We look absolutely nothing like the benchmark. I said already that we have very little exposure to some important sectors within the market, particularly energy and technology. So as a result, our relative returns to the market swing around a lot in any particular year, depending on the market environment. Less because of what's going on in the portfolio and more because of what's going on in the rest of the market or the rest of the world. So given that relative returns actually in any one year, I think don't tell us very much about how we're executing, it's important for us to have an objective framework to share both with ourselves, our management team, as well as our clients, to understand, are we executing against our philosophy? And very simply, we believe that the primary driver of investment returns over time is economic value creation. And we define economic value creation as the growth in earnings per share plus dividend yield of every company in the portfolio, and then aggregated up on a weighted average basis. So if there's a company that's growing its earnings per share 8% and it pays a dividend yield of 2%, 8 plus 2 equals 10, we believe that over time, the investment returns associated with that business should roughly equal 10. Obviously, it requires that you don't overpay on the way in and sell at a bad price on the way out. But we've done lots of statistical analysis over many decades to show that, in fact, that economic value creation is the primary driver of investment returns over the long term. Unfortunately, it actually has very little correlation to investment returns over the short term. That's okay with us. And so it's important for us to evaluate that value creation profile over the long term. And that's what you see here on the slide. The dark blue bars is the value creation for the durables portfolios in every full calendar year that we've been in operation. And the light blue bars is the value creation for the MSCI All Country World Index over those same periods. The shaded portion on the far right is the compounded effect over a long period of time. And I look at this slide and I have 3 observations. The first is that for a portfolio of businesses that most people think are quite boring and unexciting, they're actually delivering value creation. They're growing value creation at quite an attractive rate, 14%. So when I talk about businesses that sell insurance or chemicals or utilities or food cans to my colleagues, they say that's too boring for our portfolio. But at no point would they have expected that a portfolio of these businesses could have delivered 14% value creation over the last 10 years. The second thing I observe is that our record of value creation is quite a bit more consistent than that of the market. It's not exactly the same every year, but it definitely is less volatile than the market. And that shows up in the performance of the portfolio, particularly in terms of the beta and downside capture. The beta of the portfolio has consistently averaged around 0.8, and the downside capture in that 80% range as well. The third observation I would make is that our intent is to have value creation better than the market over the long term, not in every year. And so we recognize and willingly make the compromise that we are not going to outgrow the market in years where global growth is very strong and accelerating. You can see in 2017 and 2021, a portfolio of businesses like these just can't keep up with the market. That's a compromise we're willing to make because we think it still leads to the best long-term compounding profile, and that's evidenced there. Jeremy, if you can go to the next slide. Our goal is obviously to have investment returns of the portfolio be equal to or better than the value creation of the underlying businesses. So again, if the business is all in the portfolio, we're growing 8% and paid a 2% dividend yield, we would hope that the investment returns of the portfolio would in fact be 8 plus 2 equals 10 as well. Again, to do that, it's our mandate to not buy high and sell low, to put it simplistically. What this slide shows you is the relationship between investment returns and value creation for the portfolio in dark blue and for the market in light blue. And so as you can see, for a number of years, from 2015 through 2020, we in fact accomplished that objective, that the portfolio's returns were meeting or slightly exceeding the underlying value creation of the business. But really, since the beginning of COVID, the portfolio has experienced quite considerable amount of absolute valuation compression. So which is to say the businesses in the portfolio have grown faster than the stock prices themselves have appreciated. Said differently, the portfolio has gotten significantly cheaper over the last 4 years. You can say the opposite, in a sense, has happened for the market. We have had a period of particularly since 2018 for the market, very healthy absolute valuation expansion. You can see that from 0.85 to 1.12. And most importantly, from probably your perspective, the gap between the relative valuation gap, or the gap between investment returns to value creation between the market and the portfolio, is almost as wide as it's ever been, except for 2020. When we look on, it's not a slide in this deck, but when we look on traditional valuation metrics like price to earnings ratio, the absolute valuation of the portfolio is in the lowest decile than it's been since inception, and it's at the absolute low point from a relative PE valuation. So for all those reasons, we think this is an exceptional time to be thinking about the portfolio. As I said, I have all of my own money in the portfolio, and in fact, just before year end, I wrote a very significant additional check to invest even more money into the portfolio. So my enthusiasm genuinely has never been this high, not because I'm an optimist by nature. In fact, Jeremy can attest, I'm quite the opposite. I'm generally a glass half empty kind of person, but I can only look at this data. I can look at how the companies themselves are performing, and I look at their absolute and relative valuation profile, and I really genuinely think our best days are ahead of us. If you go to page 18, Jeremy, you can look at the investment performance for the portfolio over time. This page has it in US dollars. We have it in a bunch of other currencies as well. So, you know, I would say over this has through January. If you stopped at the end of calendar 2023, over 1 year, 5 year, and since inception, we've virtually accomplished our goal of 10% annualized returns, and over 3 years, we're less than that. And we've done that with, as I said, considerable absolute and particularly relative valuation contraction. And so I think while, of course, we want to meet or ideally exceed our expectations or our goals, I think that we've met our goals with this significant headwind, I think is a testament to the growth that the businesses we've chosen to invest in have in fact delivered. Another way of thinking about this is if you have a goal of running, you know, a mile in 7 minutes, and you in fact, you know, you want to beat your goal, and you said, okay, well, I essentially ran the mile in 7 minutes, but I did it with a 30-mile-per-hour headwind in my face. You would say, okay, that's pretty good. And, you know, tomorrow when that headwind no longer exists, then our returns can, or my running time can be even better, or said differently, the returns for the portfolio could be even better. So finally, and then Jeremy, if you can just go to the top 10 page. So that's all at the aggregate portfolio level. I really spend I and the team spend all of our time really deeply involved with all of the companies that we invest in on behalf of your clients. And it's really when I work on these individual companies and spend time with the management teams of these businesses that I get the most excited about the path forward. So let me just share a few thoughts on these companies. I'll say just a few sentences on a number of these businesses, and then I'm happy to take more questions, so I won't go into great detail. Intact Financial is the largest property and casualty insurance company in Canada. They are four times the size of their next largest competitor. They have structural competitive advantages that allow them to earn 500 to 600 basis points ROE spread versus the industry average. Over 3, 5, and 10 years, they've grown their earnings per share at 10 or 11% annualized and paid a 2 to 2.5% dividend yield. The company trades at an average valuation for its own history, about 12 or 13 times earnings. And I think their competitive position has never been stronger. And this year, 2024, the business of theirs, auto insurance, that gets the most attention from the market and tends to drive short-term investment performance, is set to have one of its best years on history. And so I'm really excited about Intact for the long term, but I'm also really excited about it for the short term. The next company I want to talk about is Brenntag. You'll see it as the third largest holding there. It's a chemical distributor based in Germany. This company can grow its earnings 10, 11, 12% annualized over time, and it pays about a 3% dividend yield. They are trading at the lowest valuation that the stock has traded at in over a decade because of a number of factors that the market's confused about. We take a long-term view and are excited about that 10 to 12% growth plus 2 to 3% dividend yield, and the stock trades at 12 times earnings. It's really an exceptional combination of stability and value. The next company is Engie, a French utility, about 60% renewables, 30% gas, 10% nuclear. This is a company that historically we've been a shareholder. Sorry, I should have said for Intact, we've been a shareholder since 2015. For Brenntag, we've been a shareholder since 2018. Engie is a stock that we purchased last year in 2023. It's a company that historically had a very mixed track record of delivering value creation for shareholders. They had a new CEO, Catherine McGregor, who took over 2 years ago. She's done a remarkable job cleaning up the portfolio, simplifying and selling assets, and delivering more consistent value creation for shareholders. The company pays a 9% dividend yield and will grow their earnings per share 5% annually. Very simplistically, 9 plus 5 equals 14, with a business extraordinarily low risk. To me, that's an exceptional combination of stability and value. The next company is Fineco. They are a digital wealth manager in Italy. If you're familiar with Charles Schwab in the US, it's a similar business model. They have significant competitive advantages over the rest of the industry, who are legacy units of incumbent banks. Fineco is all digital, has no physical presence. Their cost base allows them to operate at 30% lower than their peers, and they pass on a significant amount of that differential to their customers through cheaper, better value products. So they're growing their deposit base and their account base about 8% annualized. The stock trades at 12 times earnings. We think they can grow their earnings per share in the low double digits, and they have about a 4.5% dividend yield. Again, an amazing combination of stability and value. I'll just mention 2 or 3 others. Arthur Gallagher is a broker, an insurance broker in the US, family-run business. Pat Gallagher runs the company. We've been a shareholder since 2018, and they've delivered over 20% annualized growth in earnings per share through a combination of factors. The first is that the insurance brokerage business is benefiting from inflation in claims around the world. Climate change, litigation, and general social inflation, which is making insurance more expensive, is all for the better for a broker, which is essentially a pass-through business. They take a margin on the dollar value of a policy sold. So they have 3 or 4 or 5% unit growth a year, and they've been benefiting from mid to high single-digit pricing growth every year. In addition to a great industry backdrop, Gallagher has benefited significantly from acquisitions. In the last 10 years, they've spent $10 billion on acquisitions. Their market cap 10 years ago was just $10 billion. So this is a company that has spent their entire market cap in acquisitions, and that has been money very well spent. The insurance brokerage industry around the world is made up of literally tens of thousands of small brokerages that aren't scale businesses, and many of which are looking for succession or liquidity for their founders. And Arthur Gallagher is a great home for those businesses, and the runway for them to continue to do acquisitions is very long. I'll mention just 2 other companies. BWX Technologies is a defense company in the US. It's a very unique business. They are the sole source provider of nuclear propulsion to Navy submarines and aircraft carriers. They now supply that technology to Australia. I think this is the single best competitively positioned business I've ever seen. It is a of strategic importance to the US and now the UK and Australia for obvious reasons. The US's naval fleet is old and needs to, or submarine fleet, I should say, is old and needs to be replaced over the next 30 years. And BWX has a tremendous growth runway over that time period. They're also using this technology to create power solutions in other industries such as healthcare and power generation. And then the last one I'll mention is HCA Healthcare. It's the largest for-profit hospital operator in the US. They are a family-run business, about 15% owned by the Frist family. They running hospitals in the US is a very difficult business for a variety of reasons. HCA is the class of the industry. They're able to pay their doctors and nurses and caregivers the most. They have the best technology, which attracts the most patients, which feeds the flywheel and creates better financial outcomes for them, which then they're able to pass on to their caregivers, their communities, and ultimately their patients. It's a business that's grown their earnings per share in the double digits for a long time, trades at about 12 times earnings, and something I think we've been shareholders since 2015. So all of these businesses are trading, actually I shouldn't say all, but most, in the case of Intact and Brenntag and Engie and Fineco and to some extent HCA are trading at really just historically attractive, very, very attractive valuations. And it's that combination of our confidence in the businesses, the people, and these attractive prices that leave me so excited about the path forward. The last thing I'll say is, and then open it up for Q&A is, my confidence that the portfolio can continue to deliver value creation at 10% or more over the next 5 years is very high. We've done it, and I see no reason that we can't continue to do it. My confidence that the portfolio returns can be at least equal to, if not better than, the business growth is also very high. And that's just because we've endured this period of 4 years of valuation contraction. So at a minimum, I think the likelihood that we endure additional valuation contraction is low. So at a minimum from here, the portfolio should compound in line with the value creation of the businesses. Even better would be if we recover some of that ground relative to the market that we've lost. So if we go from that 0.82 back up to 1, then the portfolio can return even in excess of the businesses. And I think that's quite a possible outcome as well, without having any prognostication about what the market's going to do or what the technology sector is going to do. So just factually, I put all the data together and I'm left just really enthusiastic about the path forward. And again, I'm voting with my feet in the sense that, all or most of my family's money is in the portfolio. And in the last 3 to 6 months, I've significantly increased my holdings to reflect that conviction. So I hope that was enough. Let me stop there. I'm happy to take questions on the philosophy, the outlook, the positioning, the performance, the individual companies, whatever's helpful for you.
So as a reminder, I think please put your Q&As in the chat box. Then I have the benefit of asking you the first question here. And I remember during one of our trips, you mentioned what was unique about your top 10 holdings compared to many others is that these are names that you expect the least amount of losses, and this ultimately provides a stability for the portfolio. And that's in contrast of other portfolio managers where the top 10 stocks are usually the stocks that they actually get highest returns. Is that something that you still see in this kind of markets? And given with this compression in terms of value, do you see now a combination of both the defensive nature and potentially even higher returns going forward?
Thanks, Shankar. I would say, yeah, you're correct in that we make our largest positions not necessarily the ones with the highest expected return, but rather the ones that we think have the least downside. And we define downside through a number of variables. One is just the stability of the business. Within the portfolio, there's a range, even though the portfolio itself is much more stable than the broad economy and the broad market. So the stability of the business, the management team, the balance sheet, and the valuation of the companies. I think what's unique today, and truly unique in the 13-year history of the fund, is that actually the companies that have the least downside are in fact some of, not every single one, but the majority of the top 10. Not only are they the ones that have the least downside, but we think they're the ones that have the highest expected return. And so that's just a very unusual combination in the history of the portfolio, and one that makes me very excited. As I said, so the downside protection profile, I have a high degree of confidence in, just given the nature of the businesses that we're holding on behalf of your clients. And then in terms of forward expected returns, as I said, at a minimum, given the valuation compression that we've already experienced over the last 4 years, I think we should compound in line with that value creation. And then I think there's a very strong case to be made that we can do even better than that as we recoup some of that valuation compression that's occurred over the last 4 years.
Then on the topic of on compression, right? So we typically don't own for this portfolio names that fall into the quality, growth, and value. So what are the trigger points and what's required for these companies to be first and foremost appreciated by the market? And then, as you say, going back to pre-COVID and getting that valuation back to that levels, and obviously translating to returns for the clients in this portfolio.
It's a great question. I think, the first thing I would say is, this is my opinion. If a company's growing their earnings per share 8%, and they have a dividend yield of 2%, 8 plus 2 equals 10, and the stock goes up 10% a year, I think nothing has happened. I essentially think of that as nothing happening. And so to me, no one new needs to pay attention. No view of the market needs to change for a business to compound in line with its value creation. So that's the first thing. And the second thing is, our experience over time in some of these instances is, for a company, take Engie, for example, the French utility that has a 9% dividend yield and will grow its earnings 5%. That's a business where, the history of it is not one of stable value creation. And so I think at a minimum, we stand to make 9 plus 5, 14. But I do think as the track record of this new CEO takes hold and she delivers value creation in that level year in and year out, I think there's a chance that in, let's say, 2 years, that some portion of the investment universe would say, instead of 14% annualized returns, I'd be willing to take 12% annualized returns for owning this very stable business. And if the expected return declines from 14 to 12, that will occur through valuation expansion, i.e. that will be to the benefit of the existing shareholders. So my answer to you is nothing needs to change for them to compound in line. And for them to do better than that, I think one of two things needs to happen. Either they need to be recognized for the stability and level of value creation that we see, one, and two, capital needs to stop flowing to other areas of the market, namely technology. Like at some point, technology, I'm a big fan of technology companies. They will continue to grow and produce amazing returns. But at some point, there will be a limit to the valuations that they can trade at and the percentage of the market that they can comprise. And then that capital has to go somewhere else, or at least stop flowing out of these other industries.
So I think it's a very interesting question on as a follow-up for that, there was a question in terms of what's the reason in terms of the value contraction over the last 4 years, and I presume that's partly money moving into different industries, let's say, for example, in this case, tech, or are there other reasons as well?
It's a great question. It's something that I've studied a lot because obviously it has been a frustrating experience, and so I've picked it apart and really tried to understand it. And so the first thing I did is said, are the companies we own performing or not in absolute? And I think that page on value creation is proof positive that they are in fact performing in an absolute. The second thing is I looked at, how are they performing relative to expectations? So fine, they grew 14 or whatever the number was over the last 4 years. I don't know exactly that, but let's just say fine, they grew 10, 11, 12% over the last 4 years, but how did they do relative to expectations? The answer is that the portfolio has performed in line to better than market expectations in the aggregate in each of the last 4 or over the 4-year period. And importantly, that's actually much better than the market has done. In the aggregate, the market has disappointed relative to expectations. And so the data doesn't allow me to conclude that there's anything wrong with the absolute or the relative to expectation performance of the businesses. So I can only reach the conclusion that valuation expansion has occurred in one area of the market, namely technology, at the expense of essentially all other areas of the market, and particularly this portfolio. So essentially, it's capital flowing into one area of the market and out of the others.
Thanks, Dan. A couple more questions, and I think this is related to the portfolio again. And given how you look at the stocks and the reviews that you do in the stocks, maybe can you share a little bit in terms of your buy and sell discipline? Especially the parts where you sell a stock. We do believe you've got names that you've invested for many, many years. What situations would you sell and why? Yeah.
Yeah, so our name turnover, just to give some context, our name turnover is sort of in the high teens or low 20s. So our holding period tends to be in the 5 to 6 year range. Obviously, within that, there's, as you noted, businesses we've held for 10 or 12 years, and there's businesses we hold for 2 or 3 years or something in between. When we buy a stock, our intent is to own it forever. And obviously, that doesn't happen in all cases. And so there's really 2 reasons. If you go back to the 3 things that we're looking for, they are all, so business, people, and price, stability, management team, and price. Those 3 things are also triggers to sell. And so the bad reason to sell a stock is if the business or the people are something less than we appreciated or expected. If the business is not as stable as we thought, the competitive intensity of the industry is higher than we thought, the management team isn't making decisions that benefit shareholders in the way that we thought, that's a reason to sell. That tends to be a bad outcome. The stocks tend to have underperformed for some period of time into our decision to sell, but we make a decision to move on and allocate capital in better circumstances. So those are the bad outcomes. The good outcomes are if the price of the stock is appreciating faster than the underlying business is compounding, which is to say that the stock is getting more expensive, that is a reason for us to sell. We tend to do that slowly over time if it's purely for valuation reasons. If it's for business or people reasons, we'll move very quickly.
Then I'm going to try. We've got a message for that. Time is our Q&A time is almost over. Let me cover a couple of questions. So there's 2 parts that I can link this. There's a question about how the fund does in a slowing global growth environment. That's one. And I think what's very critical here is that how do you see this fund being positioned in a client's portfolio? I know that the bulk of your money is inside of it. And then from an investor's point of view, given the market environment, how does this play a role? Is it more tactical? Is it more core? And maybe what your points of view on this here?
Okay. So in a slow growth environment, this portfolio should do great because as you can see from that value creation page, the companies in this portfolio grow at a pretty similar rate regardless of what's going on in the rest of the world. And so if the rest of the world is struggling, this portfolio, the businesses in this portfolio will shine on a relative basis. That I'm very confident in. The second question is the role we play in client portfolios. Most importantly, the stocks that we hold on behalf of clients tend not to be held by other managers that are in their portfolio. And so we play a diversifying role from that perspective. I'd say we play a role of stability and ballast. We play a role of downside protection. And ideally, over time, we play a role of compounding value. And so, I guess one can try and time their allocation. I think if you were going to do that, now would be a great time because we've endured this relative and absolute valuation compression. I know it's hard because we like to invest in great historical returns, absolute and relative. But if you were going to time your investment, now seems like a great time. For me personally, I choose to just own the portfolio forever because, as I said, I'm happy to compound at this rate with low risk. And so I think it can go either way. The clients that we tend to work with, you guys are a great example. We have long relationships. They really understand what we're doing. And I think in many cases, our best relationships are ones where the clients have actually added to their allocation after periods of relative underperformance. And in fact, we've had 2 significant new clients join just in the last month. And that's really encouraging because I think it's a great starting point.
I think that's a nice way to, let me just have my last question. So that we've gone through a period of relative volatility. 9 years ago, when we talked about this, the world's a very different place. How do you, and you've alluded in this a little bit, how do you continue to deliver that 10% on the market cycle, especially in the next few years? And then just to answer the client's question is that when we look at 10%, this is on a gross basis, and obviously the returns can differ from currencies to currencies. We do offer this to clients in dollars, Sing dollar, Malaysian ringgit, Thai baht, and others, and some are hedged and some are otherwise. But then just maybe this is a good way to finish the Q&A session today.
It's a big world out there, and we have the great benefit of working at Wellington, where there are investors all over the world, in Singapore and Tokyo and Hong Kong and Sydney, in London and Boston, in San Francisco and Chicago and Philadelphia. And we get tremendous collaboration from around the firm. Twice a year, I get the opportunity to directly compensate investors who have contributed work and research to this fund. And on March 15th of this year, over 35 different investors from Wellington around the world in each one of our offices will receive payments for their contribution to this portfolio. It's a concentrated portfolio, just 35 stocks. I think, and we have a great team, both the 3 of us working on the team, but also the Wellington team broadly. And so, we just need to find a few diamonds in the rough whose value creation is largely independent of what's going on in the market. And if you go through the companies that I briefly touched on, really none of them are that economically sensitive. They should continue to compound, not exactly at the same rate, but largely at the same rate, regardless of what's going on in the rest of the world. So it's really because of the research team and the collaboration at Wellington that we're able to put this portfolio of 35 stocks together that can deliver regardless of the market environment.
Okay, so I'm going to end the Q&A session here. And I want to thank, firstly, Dan, for staying up so late for this. Jeremy, the team at Wellington, our participants here, I want to end this here. And I think we started the portfolio many years ago, and I think at every cycle and other funds that I've sold and talked about, the experience for this is quite unique. I think generally clients who have invested in this fund always look for opportunities to continue to top up and top up and top up. It's grown steadily over time, and I think client experience has been quite relatively fantastic. It's testament that we've got a large number of clients on this call wondering more about this fund. We're excited about this, and I think in an environment that is a little bit promising, there is a market where you do need to make your money work a little bit harder. But with all the surrounding uncertainties, I think this provides a unique opportunity to tap onto that market and maybe, like what Dan says, invest forever, right? For the next few years. but whatever is it, I think it represents a relatively critical portfolio, part of your portfolio. Okay. Thank you, everybody. It's a really exciting session. I've always enjoyed talking to Dan, and maybe Dan, we hope to see. It's been a while. It's a good time to come to Southeast Asia, and hopefully we get to bring you around again. All right.
That would be terrific. Thank you so much, everyone. And it's really a great partnership. It's our privilege to work on your behalf. So thank you very much.
Thank you, everybody.
Thank you for having us.